one of the benefits of the DEX that it will have, because it's using the same liquidity which is used on the lending market, DEX LPs will be earning both lending and trading fees. So if you have a DEX LP on Fluid, and if you have like ABC token paired with ETH, the ETH part of the LP is earning lending fees, plus the whole LP is earning trading fees. So for absolutely every project which has LP on Fluid, they have, by default, they have a better conditions than on any other DEX. Only because, on other DEX you only have trading fees. Yeah, here you will have lending fees and trading fees.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show spotlights the upcoming launch of Fluid DEX by Instadapp. In this episode, we catch up on what we believe is the most capital-efficient decentralized exchange ever, how it's powered by Fluid's innovative liquidity layer, and how it allows lenders and borrowers for the first time ever to use their collateral and debt as DEX liquidity. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. Power up your portfolio by borrowing, lending, and multiplying your favorite assets, made safe and easy by the industry-leading automation tools at SUMMER.FI. SUMMER.FI offers a curated DeFi experience to access the highest quality protocols and strategies. Discover new earn strategies for your portfolio in a user-friendly app designed to filter based on the tokens you hold, the networks you transact on, the protocols you trust, and the highest available yields. Learn more today at SUMMER.FI, the best place to borrow and earn in DeFi. Tired of hopping between tabs, searching for new tokens before the hype catches on? Try MATCHA.XYZ, the DEX aggregator from 0x. Matcha connects hundreds of DEXs so you can trade millions of tokens and find fresh new drops. Matcha works out the best route to save you money on every trade. Swaps are free and Matcha has everything you need to trade on-chain. Gasless swaps, limit orders, and cross-chain, all in one place. Search Trade Done at matcha.xyz. Introducing Flat Money, the first decentralized delta-neutral flat coin built on Base with sustainable yield that's completely untethered from legacy finance. Because DeFi needs an uncensorable based unit of currency. You can mint unit with RETH, which is held in the protocol's shared liquidity pool, where it's borrowed by leveraged traders. As a leveraged trader, you can deposit your margin collateral and go long on RETH. If you're trading in the perpetual futures market, you'll pay unit holders to open leverage positions. If you're holding unit, you'll earn yield from liquidations, borrow rate, and trading fees. Preserve your purchasing power and offset your exposure to crypto market volatility. Learn more at flat.money. Catch the tide of the mainnet launch of Puffer Finance. Whether you're an Ethereum staker or an aspiring node operator, Puffer delivers the decentralization revolution with its cutting-edge technology. Start with just 2 ETH to unlock the potential of native liquid restaking and maximize your earnings. Join the movement now and anchor your stake at puffer.fi. All right, let's introduce our friend DeFi Made here, who is the head of growth at Instadapp. DMH, welcome to the Edge Podcast. How are you doing?
Hi guys, really glad to be here. Thank you for inviting me, and I'm excited to share more news about Fluid DEX.
We've previously covered Fluid as a lending and borrowing protocol. It brings to market a lot of innovations. If you go back and listen to previous episodes, we interviewed Samyak Jain, who is one of the co-founders of Instadapp. And you'll note that the protocol itself, it has very high loan-to-value ratios. It has better rates generally for lenders and borrowers. It has some really innovative approaches to security. And what we're really excited to talk about today, and we'll let DMH talk more about this, is that we now have this feature that is smart collateral and smart debt, which is powered by the Fluid DEX. So we're going to talk all about that and liquidation penalties and how all of this is improved through the launch of Fluid DEX. So DMH, can you kick us off with just a little bit more about your background? Like, how did you get into crypto? And would love to learn more about like how did you end up at Instadapp or working on Fluid?
Sure, guys. So, my story, how I got into crypto, I was working in a completely different industry related to oil and gas. And in 2020, when because of the COVID, there was a big lockdown and all airports were shut and people couldn't move. I was working abroad at that moment. I was not able to come back to home. So at that moment, I didn't like my job. And at that moment, I realized, okay, I'm never coming back here. So I decided to learn something new. And because I had my higher education, which I wasted 6 years for, I didn't have like any other skills. I didn't know what else I can do. So I was looking into new opportunities. I was looking what can I do. Initially, I was thinking about coding, but I researched a little bit about that, and I realized that it's not the most excited work to do. So I was researching further, and then I heard about crypto. I heard that people make money somehow, and I decided to research more about it. So I was for the first 6 months I was just reading books, let's say, about crypto. What is it? About trading, about different stuff. And after 6 months, I tried to buy my first cryptos, and then I was still like actively researching crypto. And then at one moment, I heard about DeFi. I heard that people can lend money and earn on it. Like you don't need any banks and any to do any paper job to to get this interest and so on. So I was like really excited. Wow, like it's interesting. Like everyone can have access to this, and people can have access to something what in real world only super wealthy people can have access to. So people in DeFi, people can borrow against their net worth. This is not possible for normal people in normal life. Yeah. So I got excited about that, and I started learning. I started using DeFi myself, and after some time, I realized that I can try to write about it. I never wrote myself. Like I didn't have social media, so I was not writing. But I tried, and people started reading me. People started following me. And one moment, investment fund reached me out, and they hired me. And also, like it was in April 2022 when I wrote a big thread about Luna UST, which got more than like 1 million views. I had a very small account at that time. So it like became really viral. A lot of people started following me, and since then, like I started growing. So like yeah, in that thread, I mentioned that like UST is not sustainable, cannot work like that. And I didn't expect that in 1 month it will collapse to zero, but this is what happened. And then I got even more followers because people came back to my thread and they say, okay, he told that. Yeah, that's my small background. Yeah, and since then I was working more in the investment fund, and I was writing about crypto, working with different projects from time to time. It was always my goal to be a part of the project. I had several like small startups which all failed, to be honest. And in October 2023, Instadapp published a blog article about Fluid. I read that article. I realized that this is the most exciting thing in DeFi I've ever seen. And I started writing about Instadapp, about Fluid, and it was like really interesting for me. And I got in touch with the team. I was helping them here and there, like just sharing my thoughts and views and stuff like that. And after some time, they offered me to join them. And since April 2024, so only a few months before, I joined Instadapp full time, and I'm super happy, super excited about it because I know that Fluid will become the biggest protocol in DeFi. Other people don't know it yet, but they will see it, and that's why I'm happy, because I already know that this will happen.
DMH, I think when you kind of first noticed that Fluid article back in October, it was probably like shortly thereafter that you and I started communicating just a bit about Fluid as well. I think we were going back and forth with some DMs just about how excited we were about it, because I totally agree. It represents something really big and novel in DeFi, something that we haven't really seen before. So that's why DeFi Dad and myself have been covering it quite a bit over these last many months. And Fluid went live, I think, around 3 months ago. Correct me if I'm wrong, but maybe you can kind of just give us the where it's at today as far as the current product suite before we jump into more about the DEX. I think right now we've got the borrowing and lending live and the liquidity layer, but maybe break down what that means and just, again, where we're at today.
The first thing which I'm trying to explain about Fluid, that it's not a lending and borrowing market, it's not a DEX or something. Fluid is a liquidity layer. It might sound strange, and different projects call themselves liquidity layer, but Fluid is liquidity layer. On top of liquidity layer, we build different protocols which utilize the same liquidity. First one is lending protocol. Second one is vault protocols, which are, if you combine them, this lending and borrowing protocol. We also have a small protocol which is called stake ETH redemption protocol. It's like a mini application. And the next bigger protocol will be DEX protocol. And in the future, we expect there will be tens, maybe hundreds of different protocols built on Fluid. Some will be small ones, some will be big ones. I don't know when this podcast will go live, but we'll launch in the end of February. And in the first 3 months, in the first 19 days, we reached a market size of 800 million, which is pretty nice, because, initially we wanted to reach that market size, but when we were planning that, the market was different, and then all these points meta started, and then attracting lenders was very difficult. But we also took advantage of that. We were able to offer this good leverage conditions for the users and the safest on the market. People were not getting liquidated on Fluid, and we were using this oracles which track contract backing, and like this way we were able, we were charging a lot of interest on the borrowing side. Borrowers were paying high API, and this API was basically redistributed to other markets. That's why lending APRs was stable, so like almost 20%, and it was purely from the borrowing fees. But those borrowing fees were coming from other markets. That's how flexible is Fluid. We can stream this as capital flows, money flow inside the Fluid, and can stream them where we need them the most. On Fluid, we still have only very few markets whitelisted, like USDT, USDC, ETH, Stake ETH, Ether.fi. We'll be adding more assets in the near future. Maybe they will be already live by the time we launch the podcast is live. One of them is RepBTC, and also we are exploring PT assets from Mantle. It's not very easy to get them on the lending market, because people PT holders, they get fixed yield, and in case conditions change for them, in case borrowing rates become very high and their fixed rate went down, they have to realize their loss. And this will be if they take leverage, they will realize their loss at leverage. So if PT asset goes down 2% and they have 10x leverage, they will have a 20% loss. So PT assets is definitely something we're exploring and we want to add, but it's complicated from from the UX side. We want people to have, safe conditions. We are not interested to list an asset and then direct all our users. And this part is difficult, but we will see if we can find a good solution for that.
I want to chime in on my own experience using Fluid so far. So I have mostly used it to be able to create a leverage position with ETH as the collateral. I think I've been borrowing Steph, and this was a really popular farm for EtherFi's Season 2. And I mean, just some of the notes I had been thinking through in preparation for the interview is just, so in general, rates have been higher. So for lenders, that's been fantastic. There was an adjustment there to the interest rate model, and that's hugely helped folks like myself who are creating positions where you're borrowing. It's very gas efficient. I can speak to the fact that having used Aave and Maker and Spark and Morpho, I'm definitely spending less gas. It's very anecdotal, but just in terms of the current gas prices on Ethereum mainnet, that's been a real perk. Another reason I started using Fluid was just because of the higher loan to value ratios that are offered. And I think that hasn't come to full vision yet. There's much more ambitious goals, being able to borrow up to 95% against ETH with something like a stable coin. And then, I think the other thing that really attracted me is the lower liquidation penalties. As far as I know, they're as low as 0.1%. I do want to get right into Fluid DEX, but DMH, are you able to talk a little bit about some of the benefits of these lower liquidation penalties, or just how does it work at a very high level? You don't have to go into the weeds on this, but how can a liquidation penalty be as low as 0.1% when I think it's 10, 13, 15% on comparable CDP protocols or lending and borrowing types of protocols?
Yeah, it's a very good question. Thank you. Fluid lending and borrowing markets has different architecture than any other lending market, any other lending protocol in the market. How we already have the highest LTVs and the lowest liquidation penalties, and we have highest lending rates on the market, and probably we aim to have 50% more lending rates than our competitors, and we probably have even 100%. For some assets, maybe 400%. If you're talking about ETH, we have better conditions. But because Fluid is new, people are still hesitating to move their liquidity from other protocols to Fluid. But I assume in next few months, a lot of liquidity will start flowing to Fluid. So when I'm saying we have different architectures, there are a lot of small features which we make different, and they allow us to have a better efficiency and better safety on every part of the lending and borrowing market, including oracles, including limits and interest rate curves and everything. But the main difference, the biggest difference, is the liquidation model. So how liquidations are happening on other markets? For example, there are 10 positions which are flagged for liquidation. Then liquidator has to come and to liquidate each position one by one. And he should have a big bounty to perform his liquidations. Normally on the gas price that liquidators are paying on other liquidation lending markets are very high, maybe 10, 15 times more than liquidators are paying on Fluid. We have this part very well optimized. And and liquidator has to come and liquidate those positions one by one. On Fluid, you can imagine that all collateral is stored as a DEX liquidity at discount. So it's a slot-based approach where there's bet debt, let's say, the debt which has to be liquidated, it's stored as an arranged order in the deck on the DEX. And when liquidator has to liquidate position on Fluid, he liquidates unlimited amount of positions in a single transaction. So it can be one position, can be 1 million positions which he has to liquidate. He liquidates all of them with one transaction, which is as simple as just a swap on any DEX. And liquidations on Fluid are connected to the DEX aggregators. So sometimes just people who do the trades on the DEX, they can be liquidators themselves, and they get like a discount on their swaps. This is just a high-level explanation. The main thing is that all liquidity is stored as all collateral is stored as a DEX liquidity and discount. That's the main point.
Yeah, appreciate that. I think one of the coolest things about that, when I first heard it, was just that idea that liquidations are actually tied into DEX aggregators, and they're actually helping solve for these like liquidations, which is pretty cool.
Before we get back to the show, just a quick thanks to our sponsor at Mantle Network, the layer 2 that pioneered the 5th largest LST with 1.6 billion TVL called MATCHA. Since July 1st, Mantle is running a 100-day airdrop campaign called Metamorphosis to distribute a new governance token for the Mantle liquid staking protocol called Cook. The community can earn points for Cook called Powder by holding METH in Metamorphosis and simultaneously enjoying other yield and reward opportunities in the Mantle ecosystem. Users can also earn Powder by staking MNT in the Mantle Rewards Station. For more details, go to the Mantle blog at mantle.xyz/blog and follow the 0xmantle handle on Twitter for more updates.
Maybe let's get more into the DEX. So just to reiterate, you mentioned Fluid is basically the liquidity layer, and you're now building, I guess, apps and products on top of this liquidity layer. So you started with the lending platform, then the vault platform, and this next kind of like layer on top of the liquidity layer is going to be the DEX. Maybe speak to it at just a high level to start. There's definitely more components we'll dive into, but just at a high level, what are you building with this new DEX on top of the liquidity layer?
So the main benefit of the DEX, there are so many of them. This one is not the main. So one of the benefits of the DEX that it will have, because it's using the same liquidity which is used on the lending market, DEX LPs will be earning both lending and trading fees. So if you have a DEX LP on Fluid, and if you have like ABC token paired with ETH, the ETH part of the LP is earning lending fees, plus the whole LP is earning trading fees. So for absolutely every project which has LP on Fluid, they have, by default, they have a better conditions than on any other DEX. Only because, on other DEX you only have trading fees. Yeah, here you will have lending fees and trading fees. And if your asset is also whitelisted as a collateral and it also has lending fees, then you will have lending fees on both parts of your token. For example, like ETH BTC, LP, both BTC and ETH will be used as a collateral, so both of them will have lending fees, plus you have trading fees on the LP part. But the main innovations on the DEX are smart collateral and smart debt. So with smart collateral is this DEX LP which we have on Fluid DEX, but it is whitelisted as a collateral. So you can imagine that you are borrowing against an LP token. For example, you have stake ETH LP. First, you're earning lending fees. You're earning trading fees, and you can borrow against this collateral. And when the trade is routed through the smart collateral, you can imagine that the trader is borrowing one part of the debt and repaying another part of the debt. And lending other part of the debt. So if he swaps rep stake ETH for ETH, he lends more stake ETH on behalf of the user, of the owner, of the LP, and he borrows more ETH on his behalf. You can imagine this way. And the trading fee, which the trader pays, it goes to the smart collateral. So smart collateral is growing in size. So the smart collateral gets its trading fees and lending fees. But smart collateral, I mean, it is an innovation, but you can still think that this is you're borrowing against LP token, which already happened before in DeFi, despite those LPs didn't have lending fees. But still, the biggest innovation is smart debt. Smart debt allows to use a debt instead of tokens. So to use debt as a liquidity instead of the tokens. How it works? For example, you have a smart debt of USDT and USDC. You lended ETH, you're borrowing smart debt of USDT and USDC. As a borrower, you accept that your debt can be in one or another token, and it can be in USDT or USDC. So when a trade is routed through the smart debt, you can imagine that the trader is repaying one part of the debt and borrowing another part of the debt. So he is repaying your USDC part of the debt, and he is borrowing more USDT on your behalf. And because we allow to use debt as trading liquidity, it brings very high capital efficiency. I mean, like you don't need capital to have this to have liquidity on the DEX. And because it's like lending and borrowing market, you can look your position. Imagine like you have normal lending market, you have stake ETH looping position. Same here, you have your collateral and debt, and you can loop this position. And for example, if we are talking about just USDT, USDC, smart debt and smart collateral, if we are talking about 95% LTV, that's 20x leverage. At 20x leverage, you will have 20x of your collateral and 19x of your debt. So you will be you will be receiving 20x lending fees, you will be paying 19x of borrowing fees, and you are getting 39x of trading fees because your effective liquidity position is 39x. So if you deposit $1 million, you can leverage your position up to $39 million. And you get trading fees on $39 million, plus this position is concentrated. On Fluid DEX, we will have concentrated positions. It's like something between UniV2 and UniV3. So on the UX side, the user experience side, they just select a pool and they deposit liquidity there. But this, when the pool created, the governance determines what will be the parameters of the pool and what is the concentration of the pool. So the range order can be, very tight, like 1% or 0.1% or whatever. So you receive trading fees on the $39 million of concentrated liquidity. We did some math. Actually, not us. There was a contributor from the Math Capital. He did math and he calculated that at the current market rates with the past data of the trading volume, some like Uniswap and so on, with this position, users will be getting 200-something% APR on stable pair, which is very exciting, but also we realize that after we launch the Fluid DEX, we will need some time to stabilize the markets because there will be a lot of demand for this lending and borrowing and looping and so on. And we'll need time to stabilize the markets, to match the supply and demand with the rates and so on. But yeah, we're happy that this will be our headache.
Yeah, I think a few of the light bulb moments for me with Fluid DEX and Fluid as a lending borrowing protocol. One is I've always had to think, like in my own DeFi portfolio, am I going to lend? Am I going to earn interest that way? Do I need to borrow because I need like a leverage position or just whatever, just need to borrow for farming other protocols? Or am I going to be an LP? And I think historically it's fair to say that my own portfolio has reflected more of a focus on lending and borrowing. But meanwhile, it kills me because I'm missing out on all these fees in stablecoin pairs. And anyways, this is going to allow me to actually accomplish both of those. And so, like, for example, if I have a position where the collateral is, let's say, ETH, and then I borrow USDC with this new smart debt feature, I mean, basically I'm taking that debt, which is just sitting there doing nothing for me other than I'm paying interest on it, so it's costing me money over time. Now I can actually put it to work, and I could opt into a smart debt setup here where, let's say I'm willing to also have a debt that's going to need to be paid back in Tether. So now I've got the ability to contribute to a stablecoin LP pair. And like, that's just huge. Like, the numbers are mind boggling. If you're, some of the examples you just gave there, like, just do the math and you suddenly realize, again, it's never been possible to use your debt as this passive liquidity. And so anyways, what I want to wrap up here in my example, if let's say I have Ether as collateral, I borrow USDC, but I enable the smart debt feature, and I'm willing to also be exposed to, let's say, USDT Tether. Now, when some trader comes along trading on the Fluid DEX, suddenly that person could be paying USDC, and they want Tether. And so what happens is, under the hood, the USDC that they're actually trading, that is being used to pay back my USDC debt. And then it's borrowing Tether from the liquidity layer of Fluid. And now that trader walked away having paid a small, transaction or trading fee per usual, like on any DEX. They've got their Tether. And meanwhile, now I have a mix of USDT and USDC debt, but I earned a fee on it. And then obviously, like, multiply those fees by however many times folks are trading. Well, I'm going to earn a proportion of those fees. And I mean, it is a huge innovation. It's just a huge shift in capital efficiency. And I am dying to migrate one position in particular because, again, it's just debt that I'm paying more interest on or that I'm paying down like over time. But I'd rather have it earning me these passive fees.
Yeah, in some cases, trading fees, they can offset the borrowing fees, and you will be literally paid to borrow. I mean, it's not even like we were checking this. It's our current market rates and position of. I don't want to lie you. I think that was we were checking our rep staking ETH, smart collateral, and USDC smart debt, and people were paid like 80% net API on the position because just because of the lending and trading fees, because they get this trading fees on smart collateral and on smart debt, and they get lending fees and they only paying borrow fees, so they will get paid to borrow. But as I said, this will be also sort of a problem for us to stabilize the markets, because if there is too much demand and rates go up, utilization go up, so we'll have to balance that somehow. And we are always aiming to offer the best deal to the users on Fluid, But if for someone it's a best deal, for someone else is a worst deal. So we'll see. I mean, for sure, I can tell that by default on Fluid you will have the best rates in DeFi. It's just because design works like that. Until someone else creates a new design, new feature which can increase the earnings somehow. Until then, Fluid will have just the best conditions.
Teller is a decentralized protocol that enables anyone to borrow or lend using any Ethereum asset. You can think of a Teller loan as a DeFi cash advance, one where you can use any of your favorite ERC20 tokens as collateral to get an instant USDC loan. Discover the power of a DeFi cash advance today at teller.org.
At Moonbeam, we're building a world where the wonders of decentralized technology are accessible to everyone. We're advancing Web3 integration through product enhancements, funding for innovation, and investment in our partner ecosystem. Our product roadmap includes ZK initiatives, tokenomics updates, and 8x throughput. Our $10 million innovation fund invests in startups that deliver cutting-edge solutions for RWAs and Web3 gaming, and our partner ecosystem continues to grow through grants and incentives. Moonbeams is delivering frictionless user and builder experiences to create the future of the internet on-chain. Join us by participating in the Moonrise campaign today.
DMH, I'm seeing a shift in DeFi back to protocols that can generate real fees and revenue. So with Instadapp, it's a DAO. It already has a token launched called INST. I'm curious, to me, when I hear everything that you're talking about, I see so many different points where revenue or fees can be extracted and possibly accrued back to the Instadapp token. Obviously, there'll need to be a new DAO vote of some sort to institute this new change, but what can you say or speak to as far as the efficiency and potential future revenues and fees that can be generated with this arrangement? Because to me, it seems like it can be quite powerful and be actually quite meaningful in value accrual back to the Instadapp token if that comes to pass, which I have a hunch it might.
So INST token is the only token we have at Instadapp, and it's governing all the products. Instadapp has four products. One of them is Instadapp Pro, Lite, Avocado Wallet, and Fluid. Fluid is already generating a lot of revenue. We use this revenue to grow our markets further, but we expect that after the Fluid DEX is launched, Fluid will be generating one of the highest revenue in DeFi per $1 in TVL. Even now, Fluid DEX, Fluid lending and borrowing market generates 4 times more than Compound generates per $1 in TVL. And with Fluid DEX, our revenue per $1 TVL will skyrocket because, again, in some cases you don't need TVL. You don't need tokens to generate revenue because debt is used as trading liquidity. So no TVL, but the revenue is going. Since we'll have this very high revenue, and we think that Fluid will become more mature, we want to take care of tokenomics. We're exploring different solutions, what we can do, how we can make IST holders benefit from Fluid growth, from Instadapp growth. Revenue share is one of the options we're exploring, and there are different types of revenue share. Some types, there are some different types of buybacks. There is different types of direct earnings share, and so on. We are exploring different options, and if team comes up to a certain idea, we will propose this in the forum, and we will see what governance thinks about that. But definitely this tokenomics will be one of our priorities for in the future, hopefully in the near future.
Recently, we've seen a market drawdown, I think of around 20% from Bitcoin's year high of 73,000 US dollars. And so there's been a major sell-off in all tokens. I mean, some of the altcoins have sold off as much as 50, 60, 70, 80%. I'm thinking ahead in the future, once Fluid DEX is live and I'm using smart debt and smart collateral, in that scenario where markets are crashing, I guess, what does that mean for us as Fluid users? Maybe you can highlight some of the benefits or opportunities, or if there's any concerns.
So a few things you need to understand. First of all, as a Fluid user, you will benefit from this high LTVs and low liquidation penalties. And if you're using smart collateral and smart debt, if there is a lot of volume going through, you will earn these trading fees that can offset. I mean, they will not offset the drawdown of the market, but at least you will earn something on that. This is a good thing. It's a good part. The bad part, let's say, if you're holding a smart collateral and smart debt, you're exposed to the risks that you normally have as a DEX liquidity provider. Since you're a liquidity provider, you have the same risks. And for example, if you hold a token, you hold a smart collateral of let's say stake ETH and ETH, and for some reason people are dumping stake ETH and they're going out, they're selling it for ETH. So your smart collateral, it will become imbalance. At one moment, it will convert to full stake ETH position, and all ETH will be taken from the LP. This is how DEX LP works. Yeah, if people are selling one token, they're withdrawing the other token from the LP. And the smart debt is an inverse AMM, inverse pool of smart collateral. So if you have a smart collateral of stake ETH and ETH, and you have smart debt of ETH and stake ETH, and people are selling stake ETH, they want to exit their positions, you will end up with your collateral fully in stake ETH, and your debt will be fully in ETH. There is no, you will end up with having just a normal leverage position there, like stake ETH looping position. This is like a very typical position. If everything is okay with stake ETH, it's not hacked or something, you will just for short period of time you will have this normal leverage position, but you must have earned really a lot of trading fees if everyone decided to exit, and after some time market will rebalance, or you can repay, you can deleverage, you can unwind your position. Yeah, but that's as a smart collateral and smart debt holder, you are exposed to the risks which users have as a DEX liquidity providers. And this is one of the reasons why DEX, why creating positions on the DEX liquidity pools on Fluid is not permissionless, because we cannot allow any unsafe assets on Fluid. We want to have only several assets which are blue chip, and we don't see risk in them, like stake ETH, BTC, ETH, and some other assets. So, but for smart lending is just a DEX LP which earns lending fees but is not used as a collateral. We can accept a lot of tokens. I mean, we don't have any risk with that. We only benefit, and liquidity providers also benefit.
Yeah, Mitch, I think by nature, a lot of these lending, borrowing platforms become pretty sticky. And I think that's in part due to users build up a certain level of trust. Like take an Aave, for example. even if what you're proposing with Fluid is like a technical leap and maybe even better for the user, I think there's almost a certain amount of time and trust that needs to be built up. Like, for example, DeFi Dad and I have had people reach out to us and be like, hey, this Fluid thing almost looks too good to be true. You know, and there's still education and I think some time that needs to be just pass in order to make people more comfortable with it. But I think the other thing too is like, people are always worried about security and just what other risks could be maybe inherent under the hood that they might not be aware of. Could you speak to any of that? Like maybe what sort of auditing was done or any other kind of like risks that you foresee as like maybe, something to make note of for potential users?
So that's a very good point. This is true that this liquidity is sticky on the lending market. That have already the track record, and it's hard to get those liquidity providers from other protocols to Fluid, but we will try our best to get them. We are going to have we have some ideas how we'll be able to get them. For on the security part. So first thing I want to tell you is that Instadapp has a track record of 6 years, and Instadapp had up to 15 billion in TVL and 4 different products, and Instadapp didn't have any security incidents. And Fluid is a new protocol, and it's innovative, and it's a new code. It's like not a fork of a few forks combined into something new. Yeah, it's fully new code. We already had 2 audits of Fluid. And by the way, like the beauty of Fluid, because like we use the same liquidity, the same base, like this audits, they kind of checking the same things, and the new things which we build, we just add them on top without changing the base. So we already had 2 audits. We have a bug bounty. We have one more, at least one more, maybe 2 more audits lined up. And by the time this podcast is live, maybe those will be finished already. So like security is our top priority. And besides our track record and besides all those audits that we are doing, also Fluid has this automated ceilings which do not allow users to withdraw from liquidity layer more than, as far as I remember, we have like 20% per 12 hours now. So in the worst case scenario, that's everything like, someone is draining liquidity from Fluid. He will not be able to drain more than 20%. And in that moment, we have Fluid is governed by INST token, but multi-sig has a right to freeze the markets, like emergency freeze, let's say. Yeah. So in case something happens, there will be a loss, and the team will be able to freeze the markets, which we hope will never happen. But this is one of them. One of the security features that we have. And, we have this ceilings, depth ceilings and withdrawal ceilings on every liquidity layer and on every vault separately. So, I mean, like everything has to be hacked for people to get 20% from Fluid. It's like the worst case scenario. That's like completely everything got hacked, and the hacker will be still able to get 20% only. The hacker will be still limited in the amount of damage he can.
I think it's a really smart feature. It was something that when we first started covering Fluid before it actually launched, it's one of those things that kind of gets lost in the blog post because there's features there that, as a user, you get really excited for, like high LTVs, low liquidation penalties, smart debt, smart collateral. But the fact that there is this sort of like risk management automation feature built in that says if the worst possible thing were to happen, here if an enormous amount of liquidity were to suddenly exit, and it was due to some sort of exploit. You have this fallback solution, which basically sort of locks down the protocol. And again, this makes sense because we've seen this happen with other protocols. Hope it never happens here. I think you pointed out the track record of Instadapp is impressive over the last 5 to 6 years. But, we all knock on wood and hold our breaths as we say that because, we hate to see anything happen to a protocol like this that we have so much liquidity in. Quick follow-up to that. When Fluid DEX does go live, and hopefully folks are listening to this probably into the future when it's already been live, but one of the other reasons I love using Fluid is I benefit from all of the Instadapp flash loan recipes. They're the recipes you can swap your collateral, you can swap your debt, you can change that. But one of those is a migration option. So I've used that in the past to migrate you could go from a maker to Aave to now Fluid. Will there be a migration for folks that want to move over from these legacy platforms like Aave and Maker into a smart debt enabled vault on Fluid?
Yeah. So this Refinance feature, we'll have it live in Fluid maybe this week or next week. So in the future, it will be already live. This will allow users from other platforms to migrate their positions in 2 clicks to Fluid. For the smart debt and smart collateral, I am not yet sure how exactly it will be shown on the UI. Because if you have ETH, collateral ETH, and USDT debt, it's we allow to shift it in 2 clicks. But if we want to shift your USDT debt into USDC smart debt, I just don't know yet how it will look like.
No, this is great. This is our candid sort of feedback because we're still so new to this. It was actually a question that was top of mind for me as well. When this goes live, do you have any sense of if I have, let's say, smart debt and I'm exposed to USDT and USDC debt, I'm imagining that let's say I've borrowed against Ether, I'll be able to see that I owe $10,000 of USDC debt and $10,000 of Tether. Because right now it's crystal clear just because there's only 2 parameters. There's a collateral and there's a debt, but technically you could have a basket there. And honestly, I'm imagining that at some point, let's say someone wants to close out their debt position. Let's say that they have they owe 10,000 of Tether, 10,000 of USDC. I'm imagining that there will be some sort of feature where you can just basically sell the Tether debt into USDC debt and just pay it all back in one coin or the other. So lots of obvious features I think that will be added here, but the underlying innovation is the most important thing here. It's really complicated, obviously, to build out this liquidity layer and to enable this sort of new way of lending and borrowing and having this greater capital efficiency.
Yeah, we'll have all this we call it strategies even now. If you see people who are using Fluid frequently, they saw that there are the small strategies you can leverage in 1 click, deleverage in 1 click. You can swap the vault. For example, you have your ETH USDT vault position and you want to swap it to ETH USDC. So everything is done in 1 click. And same when smart debt will be there, users will be able to close their positions in 1 click as they do it how everything will be very smooth. So your UX on Fluid is very smooth, and we are working towards making it better. And by the way, if you haven't tried simulation mode on Fluid, you're I don't know what you're doing in DeFi. The simulation mode is like the best thing like you can try out. It's actually, we forked Ethereum blockchain, and like we run the simulation mode on the fork, and it works so good.
This is something I used before opening one of my positions on Fluid. You just click the little checkbox or like switch in the top right. And once you've got that going, you can, with this forked version of Ethereum, you can deposit any of the supported tokens, which makes it really convenient to start to play around and say, all right, let's say I'm going to create a position where I have smart collateral of Ether and EE from EtherFi, and I'm going to borrow USDC or Tether. Like, you can do all sorts of things there, and you can use the flash loan recipes, which again are these like Instadapp recipes that if you've ever used Instadapp, like you'll recognize them right away. So, I mean, this is all a part of like building this app that is really like a hub for all possible DeFi use cases. And I think like to this day, obviously the two most powerful use cases, I mean, one is always going to be trading. Like, above all else, just being able to trade whatever you want, whenever you want is extremely powerful. But the other one, of course, is lending and borrowing. And that, of course, is falls under a greater umbrella of leverage. So crypto folks love leverage. We love it. So guys, this is a great place for us to wrap up, though. DMH, thanks so much for coming on. I want to remind our listeners that they should learn more about Fluid by going to fluid.instadapp.io. They can also just go to instadapp.io to learn about like the legacy product there, but highly recommend you check out the Fluid website. Follow 0x Fluid on Twitter. Follow Instadapp on Twitter as well for product updates. And then also be sure to follow DeFi_made_here, which is DMH's Twitter account. And all of that's in our show notes, so you can easily reference it. DMH, can you close us out, though, with just any ETA for when Fluid DEX will go live? We're recording this around the very end of June 2024. So this could be live in a matter of a week or weeks here. And then is there any other product that you can tease us with that might be built on top of Fluid, or maybe that you're hoping will be built on top of Fluid's liquidity layer?
Regarding the Fluid DEX launch, we were expecting to launch it in July. Then, we still have like some developments in parallel. So, for example, we're launching on Arbitrum. We are exploring launching on some other blockchains. We are bringing new features to Fluid, and all of them they delay Fluid DEX. So if we spend 1 day on new feature, it's like the DEX will be delayed by 1 day. Now the ETA for Fluid DEX is first week of August, which can be delayed by 1 week in case we have some extra development going on. But Fluid DEX is our priority. We want to prioritize it over other features, but we cannot say, okay, we stop doing anything before we launch Fluid DEX. No, we still do other things, and Fluid DEX will have to wait maybe 1 week or something. Regarding the protocols that can be built on top of Fluid, so I already mentioned that we have the stake ETH redemption protocol, and we can build this small redemption protocols for EtherFi or for symbiotic LRTs. This is a small feature, but it's very useful. But if we are talking about big protocols, one of the protocol which we have not been designing yet, but personally I keep in mind is a stablecoin. Again, like no development, nothing, but this is something I would really love to have to build. And other big protocols can be everything. It can be like prediction market, it can be margin trading. I mean, let's say futures. That can be any DeFi protocol that utilizes liquidity can be built on top of Fluid. So after the DEX is launched, after we stabilize the markets, after we launch DEX on other blockchains, and everything goes smooth, we will be launching more protocols. We will announce them later when we starting to develop and when we create the design for them. Yeah, and also really thank you for having me on this podcast. I am not visiting any podcasts often. I would say that this is my first one. So it was very nice experience. I like it. Thank you so much.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And for future episodes of the Edge podcast, please check out our link tree at edge_pod.